Hello YouTube, Tim Erickson back for another episode of my $10,000 to $100,000 challenge investing on Robinhood. Giving a quick update here for the portfolio this week. We are only 1 week into the challenge. I launched it a week ago. As you'll see, we ended this week up a little over $300 from our initial investment. All in all, not bad considering this week the market was down quite a bit early in the week and just recovered here towards the end. And I will show you, the 1 week chart here in a little bit that shows the swings that went on throughout the week. Although there is a lot I want to talk about in that regard because some of the swings shown aren't really truly, telling the story, and part of that is because of the option strategy that we've been using. It causes the values shown for the options to kind of vary widely and sometimes almost present numbers that aren't really realistic or attainable, which can affect the value that it's showing on our account in the short term. But I just want to make sure you people are aware of what can happen in that regard so that nobody panics if they think the sky is falling or anything like that. Because even when the market was down a little bit this week, none of our options were anywhere close to the money. But there was a day where they were showing a massive negative value, and as you'll see here, if I click on the 1 week chart, it was actually saying our account balance was down to just over $8,375. So they were saying we were down almost $1,600 and change dollars, right? Which wasn't really the case. And on the flip side of that, that same day, right? This is March 23rd. It said we closed the day up at $12,490, and that also wasn't really true. And the what I mean by that is what was really happening that was showing kind of that wide swing in the account balance was there really wasn't a lot of demand for some of the options that we have open, and so the bid-ask spreads on the options were numbers that were all out of whack, even though the numbers they were showing were crazy, but there was really no real volume on it, so the prices weren't real in a sense. So for one example, if I click on this spread I have on AbbVie, right? We're almost $10 from the money right now. It's actually further from the money now than when we opened it. We opened it for a credit of $16 each. So because we have two contracts, we got $32. So we got $16 each, or 16 cents per share, right? They're currently saying it should be 70 per share, and so we have a big loss on this position. I'm telling you that this number is not really realistic, and the market's closed today, so I can't show you a way to try and correct for that. But when the market opens, if I were to put in an order to try and open this at a price of 20 cents a share, if it's really worth 70, that should execute in a heartbeat, and it should execute much closer to 70. But in reality, what's going to happen is it's not going to execute. The market price will probably adjust once there's actually a realistic bid in the market, and instead of showing 70, it'll drop down and show it down at 10 cents or something like that, in that range. Somewhere more in the range where it should be, right? That does happen on the opposite end too, because you see here several points along in the week they said it was only worth 4 to 5 cents a share, and those weren't really realistic prices too, because I did actually try putting in close orders for a lot of these positions at those prices, and they didn't execute. So that just tells you, there was nobody to take the other end of those trades at those prices. So the numbers weren't really realistic. But I just wanted to point this out to you so that if you guys see some weird fluctuations in your account balance, nobody really freaks out, because, and again, if you do it when the market's open, you can put in an order yourself, even one that you don't expect will execute, but will just to help bring the prices down to maybe closer to reality, to maybe ease your fears on that. But so you see these wild swings here all the way up to 12,006, immediately down to 8,000. Just 10 minutes later. Like, those clearly were not real numbers, So just wanted to make sure you guys were aware that sometimes the swings shown like that do not really represent what's going on with your portfolio. Now, that doesn't mean to say the portfolio is going to be pretty steady. Just the fact that we're trading with options and also that we're trading on margin does mean that we are going to have some pretty big swings. It's going to be much more volatile in our account than it would be if we were just investing in stocks, right? But at the end of the day, it's really these crazy swings that weren't realistic, and they were easy to tell they weren't real because when you'd see the option prices in here that didn't make sense, if I would go in and place another order, it would basically correct itself right away. So that's the gist of what was going on here on our account. Just wanted to make sure nobody was spooked if they saw something similar happen in theirs. And the way you can tell about it is just look at your option positions. I have several option positions open now, as you guys can see. Basically, almost all of them are relatively close to the same prices as when I opened them, with this one exception on AbbVie. Everything else is pretty wild. Now, there are some that have already gone down in price a little bit, which is good because, again, I want them to go to zero. So you see here this one on CVS. We received a credit of $36. It's estimated to only cost $28 to close today, so we could close it out for a profit of $8. That's not enough profit for me. I only received 9 cents per share when I opened it. Its estimated it's worth 7 now. I'd like to get this down closer to 1 or 2 cents before I consider closing it. And even then, I would only close it if there's still a significant amount of time left until the expiration date, which on this position is April 30th. So if it gets close to April 30th and it's only worth a penny or two, I probably won't bother closing at that point. But if there is a long time left until expiration and we can keep or lock in most of our profits, then it makes sense to spend the couple pennies to close it so our collateral is released and we can go place that somewhere else and start making even more money. So to give this update, I just want to run down a summary of some of the options that I have opened, and then I haven't really been able to close any of them yet. Like I said, when some of the prices were showing down in those really small amounts, like for AbbVie, I opened it for 16 cents when it was showing 4. I did try and close it, but it wasn't filled because, again, there really wasn't demand for it at those prices. But just to fill you in on some of the other positions I have open, so this one I have on Amazon, which I actually talked about this one in more detail in my video where I explained the option spread strategy, but as you'll see, I opened it for a credit of $170. At one point earlier in this week, it could have closed it for a much lower price, and this is when Amazon price had run up, close to almost $3,200 or so, but it wasn't quite low enough yet where I wanted to take my profit, so I let it ride. Amazon stock price tanked these couple of days, and you see the price of the option went up. And right at the end of the day on Friday, Amazon price started creeping back up again, which brought the price of this option down again. So this is one where if I had more excess collateral, I might have looked to open more positions around $1.80 or so. This one I opened at only $1.70, so I would have considered definitely opening more if I had some collateral available. Didn't really have enough available that I felt comfortable opening another one at this time. As you guys will see here, I currently have just under $5,000 of collateral against all these option positions right now, and that really is about the max that I want to employ in the short term. As my account value grows, I will grow that amount, and I will start using more there, but for those of you who recall from my intro video, I talk about the short time frame to compound your return, and how I was looking at 2-month time frame just as a hypothetical in that scenario, because I'm doing a lot of option contracts that expire in 2 months or less. I do have a couple down here at the bottom that are slightly longer, but some of these are positions that we also might look to close early. So, and the reason I'm looking at that was I'm really looking at opening these positions at credits that net me anywhere between 15 to 20% of my collateral as a credit. So if in 45 to 60 days I can get a 15 to 20% return on my collateral, that's really good, and that'll compound extremely quickly, which will let us accomplish our goal very fast, assuming we keep being correct on our bets here. But so this is just moving down the list on some of the other positions I have open. You'll see here these two stocks, EPD and ET. These are both oil and gas midstream companies, so they don't actually mine or drill for oil or natural gas. They just mostly serve in transporting it via pipeline and things like that. They also own storage facilities, shipping terminals, and things like that all deal in the transportation of energy. Those are stocks that just got beat up last year during the COVID-19 pandemic as energy demand plummeted. They both yield pretty highly, and I think they're way under where they were valued prior to the pandemic. I think there are a little bit of some concerns, if the administration will hinder, further development for oil pipelines and things like that. But at the end of the day, they also already have vast amounts of existing infrastructure, and there is still a very high demand for natural gas and oil. And I think probably will be for the foreseeable future, even as we start to transition more to renewables and solar. I think for the next several years, oil and natural gas are still going to play a large role there. So I opened these put spreads, again, betting that these stocks weren't going to drop below these prices. I don't own any of these in the portfolio for the challenge, mostly because Robinhood will not allow me to buy them. And the reason for that is because they're actually organized as what they call a MLP, or a Master Limited Partnership, which is just a different tax structure for the company, basically, which causes them to issue a K1 to all of their shareholders, which can complicate your taxes. And I don't think Robinhood really wants to deal with that. And so, they've chose not to allow people to purchase these stocks. I am still able to trade options on them. And also, if you're somebody who does your taxes yourself, the K1 will complicate things, so it might be better to just avoid them. But those are, again, some of the positions I opened. One of the reasons I really liked opening this one on Energy Transfer is because their dividend date actually comes up right at the beginning of May. So this is the last expiration contract right before their dividend date, which, most of the time you expect stocks to trade a little bit higher right before their dividend date, because if you own it on the dividend date, then you get to collect the dividend. So I was betting that this stock wouldn't drop below $7. It's currently just under $8, so we got, it could drop 10%, and this option would still expire worthless. And with its dividend date coming up, I think that's one less reason to expect it to continue to drop. So I opened these at a relatively low credit. I only got 7 cents, which, based on my collateral of 50 cents per share, means I'm getting about a 14% credit. A little bit lower than I usually like, but I felt like this was a relatively safe option, so I went for it. I also have, you'll see here, most of these are stocks that I actually am invested in the challenge as well. Not to say that you have to be invested in the stock to trade the options, because you don't, but, there's, as somebody who, works his own full-time job and has 2 kids himself, there's only so much time I can dedicate to researching different stocks and whatnot, and so I tend to stick with what I know. That doesn't mean that there aren't better options out there to invest in and or trade options on, but these are ones that I've researched, and I, again, encourage all viewers to do your own research also. But for the time being, you see there are a couple others that I'm not currently invested in. This one here is on AT&T. This is a stock that I may choose to add some positions into the challenge eventually also, but again, since I don't have a ton of money yet in the challenge, we're kind of limited to our first 8 positions. As it grows, we will add some more stocks to that as well. But so you'll see here, basically all of these. Here's another one on WP Carry, just more options that I opened. This one has a May expiration. I opened it for 75 cents credit, and that's on $5 collateral, which again will equate to a 15% return on the expiration. And then with all these credits I was receiving, all this money, I basically took that and reinvested it into more stocks in the portfolio. So as you'll see here, from the time I first launched the challenge, I increased my position in AG&C by a couple shares just for some extra yield, bought an extra WP Carry, bought a bunch more Bristol Myers. I think I started with 20, I now have 26. And a couple more AbbVie. I started with 12, I got 15, and I added one more CVS also. The CVS actually bought down at like $72.25, I think. So, definitely happy to see that one run up as much as it has already. So I'm just curious if I can see here the price I executed it at. Yep, here it is. I bought one share at $72.25. We're already almost 76. So definitely happy I bought that one there. When the market was down, I did wish I had a bit more money to buy, but there'll be several more swings like that along the way, so not really something I'm too worried about. I did look at opening more option positions as the market was down, which I felt like was a good time because I was getting better credits for prices further from the money, which again means they're a little bit safer. And as the markets run up, the values of them have started going down. through the next couple of updates. Hopefully some of them deteriorate enough in value that I feel confident in trying to close some of them early and being able to reposition the collateral. But in the meantime, we are going to be playing a little bit of the waiting game. You'll see that most of these do expire at the end of April, which is about just over a month away. So hopefully over the next couple of weeks, we'll be able to have a little bit more excitement in the challenge as these get closer to expiration. We can look to recycle some of that collateral. But the one other thing I did want to point out is I also traded some short-term spreads on SPY, and you'll see here in my history I have some put expirations. So if I come over into my option events, you'll see here on the 19th I did just that one contract, and then here expired on the 26th. I have two different spreads prices, but really it was 3 total contracts, and they all expired worthless. So I got to keep all the money from those. It wasn't a huge amount of credits. I think it was like $26 or something. But for 3 spread contracts, that was only $300 collateral, and they were only open for like 2 days. So that was a really good return. That's definitely something I'm going to look to employ, kind of with this remaining buying power, at least until some more of these expire. But that is, I think another nice way to continue to add to the portfolio. So this is our, again, week 2 update for the $10,000 to $100,000 challenge, and I look forward to following up with you guys in the next video.